All right. Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to a Friday live stream. We got a lot to cover today. There's so much going on that I figured I would just hop on a live stream, and that might be the most efficient way to cover all of the recent news. But I want to start things off today with a warning from Warren Buffett regarding the US dollar. So, you've probably heard for years, myself and others in the hard money and the stacking community sounding off warnings about the loss of purchasing power of the US dollar. But you don't have to take it from us anymore. Now we have heard it from the Oracle of Omaha himself at the recent Berkshire Hathaway annual shareholder meeting. We got a warning about the US dollar from Warren Buffett himself. So let me switch screens here and we will play a clip and you can hear that in Buffett's own words. And do me a favor, if you are here in the live stream and you can hear me loud and clear, just put a 1 in the chat. And while you're at it, why not smash that like button as well? I would greatly appreciate that. So here is what Warren Buffett had to say regarding the US dollar and his fears about it.
And obviously we wouldn't want to be owning anything that we thought was in a currency that was really going to hell. And that's the big thing we worry about with the United States currency. I mean, the tendency of a government to want to debase its currency over time there's no system that beats that. Fiscal policy is what scares me in the United States because it's made the way it is. The value of currency is a scary thing.
Okay, so there you go. In his own words, Warren Buffett tells us that fiscal policy is what scares him about the US dollar. And I mean, his verbiage here is pretty significant, right? He's saying that they don't want to be in a currency that is going to hell, and that is what concerns them about the US dollar. Now, one thing that you really got to pay attention to here is Warren Buffett rarely will speak this bluntly about any kind of macro risk. And obviously, he's a smart guy. He is one of the world's most successful investors. So when he starts warning about the US dollar and the risks inherent to it, we should really absolutely pay attention. And we're going to talk about gold and silver in today's video as well. I see some folks chiming in on the chat regarding that, saying they favor gold right now. We'll talk about the gold to silver ratio. One thing I do want to say is a shout out to SD Bullion. They're the channel sponsor. Thank you to SD Bullion for supporting the channel. Right now, they've got a deal that you might be interested in if you're a stacker. You can get some silver dimes at spot price. So you add this to your cart, and when you go to checkout, it applies a discount that allows you to get some junk silver at spot. Right now, gold to silver ratio is north of 100. Very rare that happens. I personally would be favoring silver here between the two metals just because silver is so much cheaper. But look, I mean, anything but the dollar at this point, right? Anything but fiat currency. And certainly if you want the sure bet, I would say there's nothing wrong with stacking some gold right now. Gold is, a great thing to stack. I stack both metals. As you saw in the intro to this live stream, I've got some gold, I got some silver, I got some gold backs. I got all the non-fiat money, right? The hard money. But this is the US dollar index. This is April 2nd, Liberation Day, with this arrow pointed here. And, before people start accusing me of Trump bashing, yeah, we're going to talk about tariffs in today's video. It's not Trump bashing. It's just, the tariffs clearly have had an effect on the US dollar. But it's not just the tariffs, although we will cover them a bit in today's video. I just wanted to look at the chart of gold here, though. That's why I pulled this up. Gold, is sending us the real warning signal here. Not just Warren Buffett, but gold. So let's just take a look at this weekly chart of gold real quick. So After the great financial crisis in 2008, we saw this run up in the price of gold, but then it's been consolidating ever since 2011 up until 2024. So more than a decade of consolidation. But this breakout that happened last year, this is also a warning sign about the US dollar, right? It's not just Warren Buffett, it's the gold price itself is sending this huge warning as we venture into the economic twilight zone deeper and deeper as 2025 plays out. Now, one thing he mentioned was fiscal policy is something that concerns us. And I know that, there's been a lot of optimism surrounding things like DOGE and cutting wasteful spending and getting rid of waste, fraud, and abuse. And while that is maybe, a real thing to be happy about, the reality is that the fiscal policy in the U.S. continues to put us deeper and deeper into debt. So this is a review from the Congressional Budget Office regarding the debt so far, or the deficit so far, as of April 2025. And the federal budget deficit has totaled $1.1 trillion in the first 7 months of fiscal year 2025. That is actually $196 billion more than the deficit recorded during the same period of fiscal year 2024. So here's the thing. This is from the White House itself, right? So I oftentimes have been hearing in recent videos where I'm remotely critical of tariff policy that I'm just citing, biased media outlets and things like that. Well, this is the White House itself, and it says, fact check, President Trump will always protect Social Security and Medicare. And I've highlighted here, the Trump administration will not cut Social Security, Medicare, or Medicaid benefits. President Trump himself has said it over and over and over again. This is from whitehouse.gov, and that is true. They're not going to cut those biggest items in the federal budget, and therefore the spending is never really going to get under control. Here's the other large item. $1 trillion defense budget for the first time ever. That's what's being unveiled by the administration. So the spending is not getting under control. And, we might need $1 trillion defense budget considering the geopolitical situation that we find ourselves in and how things are rapidly deteriorating on that front around the world. But nonetheless, we're going to be spending a lot of money moving forward. And then the other item that's really a major item on the federal budget is the interest on the national debt, right? That surpassed, I think it was last year, $1 trillion for the first time ever. This year, rates are elevated right now compared to when a lot of this debt that we have was taken out. There's something like $9 trillion in debt that is going to have to be refinanced over the next 12 months at a higher interest rate than it was originally taken at. So the interest cost in the national debt is going to continue to balloon. So all of these factors are part of why Warren Buffett is warning about the US dollar. It's why he's so concerned about the purchasing power of the US dollar, because the spending simply has not, and probably at this point cannot, be brought under control. I don't think there's a politically viable solution because, everybody wants to cut the waste, fraud, and abuse, but, we really need cuts to Medicare. We need cuts to Social Security. These are unviable programs. And I know, look, people paid into them. I paid into them too. But the reality is that they're just going to either not get paid or they're going to get paid in devalued currency. This is Jerome Powell here. I want to talk about the recent FOMC, but it was Alan Greenspan, the former chair of the Federal Reserve, who warned us in congressional testimony something like 2 decades ago now that benefits for programs like Social Security can be paid in any amount because, we can always print the money. The Fed can just monetize debt. They can guarantee payments in any quantity. But what he said was that we can't guarantee the purchasing power of the dollars that the benefits are paid in. So that's likely the track that we are headed towards. Now, regarding the most recent FOMC meeting, if you caught that, Powell always tries to paint a rosy picture about things. He says that we have a strong U.S. economy, but they didn't cut rates at the recent FOMC meeting, despite repeated calls from Trump himself and the Trump administration to cut interest rates. And Powell cited the level of uncertainty right now. And there is a lot of uncertainty because there's been a huge amount of waffling about, the trade wars and the tariffs and the, extent to which those will continue. I mean, one day you hear a positive headline, the next day it's a negative headline. This has just been all for the past month, really, just constant back and forth. And the other thing that Powell cited was that right now, the risks to the economy are rising. And that is the risk of higher unemployment, but also the risk of inflation. So the Fed has this dual mandate where they are supposed to create price stability and maximum employment. But what we're headed towards is a stagflationary crisis where the Fed, really, they're going to be damned if they do, damned if they don't. At this point, if the Fed were to hike rates, it would completely implode the markets and implode the economy and create an immediate financial crisis. However, if he were to cut rates, then inflation will likely run out of control. Now, I also need to throw this caveat out there that I'm going to talk about the potential impact of tariffs on prices. And I may, especially because this is a live stream, I may refer to that price increase as inflation. Now, I'm aware that in the traditional sense, or the older definition of the word inflation, and in my view, the real definition, inflation is actually just the expansion of the money supply and rising prices as a result of that. But, forgive me if I talk about tariff-induced price increases as inflation here. And that's the thing that Powell was also warning about, saying he doesn't want to cut. Yeah, SG in the chat here, he says Powell cuts, he helps Trump. He won't do that because he's political. Well, yeah, there's been a lot of speculation about a politicized Fed, although keep in mind that Powell was originally appointed by Donald Trump during his previous administration. So I don't know why he would be politically opposed to Donald Trump, although that's the picture that Trump himself paints. Certainly, he says, this guy doesn't like me much. But look, I mean, I think that the whole rift between Donald Trump and the Fed chair is all just kind of political theater. That's my take. I think that, the Fed and the current administration, just like all the administrations before it, they're all working towards the same goal, which is dollar debasement, right? The Fed maybe just needs some more political cover before they can cut rates, because if they do cut rates now and then prices soar out of control, that's not going to be a very good look. But if the Fed waits until there's a economic crisis, which is what we're heading towards, they'll have plenty of cover to cut rates and debase the currency and print more dollars. So let's see. Recently, I mentioned how there have been all of these announcements back and forth, right? Like one day we hear there's going to be tariffs imposed, markets crash. Next day we get a positive piece of news and markets soar. Well, here's one, that the US and the UK have reached a historic deal. So this was published yesterday on whitehouse.gov. According to Donald Trump, they've reached this great deal between the US and the UK. I don't know why the UK is like the first one that we've reached a deal with, but it's not really much of a deal if you look at it. It's 10% tariffs. The reciprocal tariff rate is still in effect. And again, I'm citing this from the White House so that you can rest assured I'm not just reiterating biased media narratives. This is the White House itself telling us that the reciprocal tariff rate is remaining in effect. So what kind of a deal is this? I mean, they hammered out a few things, but the UK still has retaliatory measures in effect against the US. We still have a 10% tariff on them as announced on quote-unquote Liberation Day. So I think that this is just more evidence that this is largely political theater, right? They're floating out these positive announcements in an attempt to buoy markets, an attempt to get investors to move into these markets. And look, I mean, this is evident everywhere. Now, how important is a trade deal between the U.S. and the UK? Well, this is from Visual Capitalist. This is an infographic which shows the U.S. largest trading partners. This is from 2022, so it's the most recent infographic I could find, but it illustrates the point pretty well. Here's the UK, right? they're very low in terms of the amount of imports and exports to the U.S. I think it represents something like less than 3% of total U.S. foreign trade. So this is hardly, a deal that we need to be celebrating. We need to look for deals between the U.S. and China, that's the big one, and also the U.S. and Canada and the U.S. and Mexico. Those are our biggest trading partners, but that hasn't manifested itself in any significant way. And, we've been hearing a lot about negotiations between the Chinese and the U.S., and one of the things that Trump recently said here is you better go out and buy stock now because there's all these deals in the works, right? Deal between the U.S. and the U.K., maybe a deal between the U.S. and China. Over the weekend, there's going to be talks between U.S. Treasury Secretary Buffett and a Chinese delegation. Now, this whole thing is just more evidence of how this is political theater, if you ask me. You have got Buffett, who claims that he was already scheduled to go to Switzerland to negotiate a trade deal between the U.S. and the Swiss, and it just happens that the Chinese delegation was going to be there. Like, how fortuitous that they happened to be there at the same time. But it does hint a little bit, I think, at desperation of this administration to figure out a way to avert the looming crisis that is going to come as a result of the trade war with China, one of our biggest trading partners, where right now, we are essentially at embargo levels. That is what Donald Trump himself says. 145% tariff levels means basically no trade between the two countries. And this is a huge risk. This may be the thing that kicks off the Fed being forced to decide between their mandates, right? A crisis, an economic crisis brought on by the trade war between the U.S. and China. Now, to be fair, this crisis that we are heading towards was inevitable, but it looks like this trade war thing might be the pin that pricks the U.S. bubble economy. And, there was an interview I saw with Buffett where the reporter was trying to get Buffett to acknowledge, like, who called who first. Was it the Chinese that called him, or was it the U.S. that called the Chinese delegation to set up these negotiations? And Buffett kind of refused to answer. He just kind of obfuscated and gave some vague answer that indicated that, he wasn't, it was a non-answer. But it's probably the U.S. reaching out to China here to try to settle, this trade dispute. Look at this post from Donald Trump earlier today. It was 7:26 a.m. this morning on Truth Social. 80% tariff on China seems right, up to Scott B. So it's like these numbers are just getting pulled out of a hat somewhere. And this is, again, an attempt to throw the markets a bone. We saw what happened when Liberation Day was announced. You got this huge sell-off in U.S. stocks, and then the reciprocal tariffs were paused by 90 days, probably ended, because, if they go into effect, we see what happens. It's going to collapse the markets. And now it's like the markets are just reacting to every tweet, every headline. It's not a good sign, right? It's not an indication of strong, healthy markets or a strong, healthy economy. It's an indication that the markets, which are already at incredible bubble level territory, right? The only time that markets have been more overvalued than they are right now was in the dot-com bubble. Even before the major stock market sell-off in 1929 that issued in the Depression, stocks were not valued at as high a multiple as they are today. So, it's like these attempts to reinflate the bubble when they've already maybe been pricked by the trade war are becoming more and more evident, I think. Let's see. Yeah, so Trump's telling people to buy stocks. This is a report from Bloomberg which indicates just how significant the price increases could become if a deal isn't reached between the U.S. and China sometime soon. So there's one ship that they followed which had $564 million worth of cargo on it. It's the IHS Market, one of these big, carrier ships, big container ships. And according to the Bloomberg breakdown, which is behind a paywall, which is the reason why I don't have it pulled up right now. I'm looking at a report on the Bloomberg report. But the Bloomberg report showed, after going over all the bills of lading, that it's an estimated $417 million on all of the goods on the ship. That's the amount, the tariffs, the amount of tariffs imposed on those goods. And they have an infographic here to kind of break that down. So $564 million worth of stuff on the ship, $417 million in tariffs, and that is in addition to existing fees. I also want to point out here that, the U.S. has not done itself a favor here, and this is a part of why this tariff war is going to be so detrimental to the U.S. dollar, not just because it could issue in a recession here where the Fed has to print money to stimulate the economy, but also because the dollar status as the world reserve currency is really being put at risk here. And it's been being put at risk for years. Under the Biden administration, there were plenty of decisions that were made which supported the shift towards de-dollarization. Following the Russian invasion of Ukraine, they seized Russian assets, dollar-denominated assets. That made a lot of nations wary about holding dollar-denominated assets. It's part of what kicked off the big rally in gold was the fact that, gold is that asset that doesn't have that counterparty risk. But look at what's happening here. So China's exports are actually surging in April because shipments to other Southeast Asian countries have offset the plunge in U.S. trade. And it's the same story between the Chinese and Canada. Canada has seen a surge in its exports as well. I thought I had a headline here regarding Canada's trade data. Maybe not, but Canada saw their second largest increase in exports. Oh, here we go. Here it is. Yeah, so it's from the South China Morning Post. So, obviously take that with a grain of salt. But this is just facts based on Canadian economic data that was recently released. So the National Statistical Agency in Canada pointed to a 24.8% surge in overseas shipments in April. It's the second largest percentage increase on record. So Canada's trade with the U.S. is plummeting, but their trade with the rest of the world is skyrocketing. And, part of the underpinning of the dollar status as the world reserve currency is that most global trade is settled in dollars. But if all of a sudden the U.S. has declared a trade war on the rest of the world, how long is that going to last? We've got a fiscal crisis and debt crisis looming here in the U.S. Even Warren Buffett is warning about it, so it's not like this is tinfoil hat stuff. The mainstream is pointing out that there are some serious risks in the U.S. dollar right now, and at the same time, we're seeing some of our biggest trade partners like Canada and China, they're beginning to send those exports to the rest of the world. I mean, one thing about the trade war that I don't really understand is Donald Trump says that we have a terrible deal going on between the U.S. and China, for example, right? Because our trade surplus is, we have such a trade deficit with them. They have this huge trade surplus with the U.S. And I want to talk about this headline here in just a moment. But the whole idea that, we're getting a bad deal because we're sending China billions of dollars of printed fiat currency, and they're sending us huge amounts of real tangible goods and things that we, actually can use. I don't see how that's such a bad deal for the U.S., right? So they send us stuff, we give them dollars, and then they end up buying U.S. debt with that. So they loan us the money back. Do we not want them to loan us money anymore? Do we not want them to have these dollars to reinvest in U.S. debt? This is one of the things that has been enabling the U.S. to live above its means for so long, and it's enabled us to expand this massive debt bubble, is the fact that we ship the debt overseas and then they send us back real stuff. Well, that's all coming to an end now. Although, this should be a huge warning sign to people out there. The U.S. trade deficit jumped to a record high in March on pre-tariff import rush. So what's happening is all these importers are buying stuff, and I think U.S. consumers may be doing this as well, right? They're going out and they're buying a bunch of stuff because they're afraid prices are going to be rising. But what does that mean for future consumption, right? U.S. consumer is something like 70% of U.S. GDP. So, we just got some relatively poor GDP numbers, but those may look a lot worse as the rest of the year goes on if consumers just bought a bunch of stuff ahead of the tariffs. Well, that means that their consumption moving forward, at least for a time, will be diminished. So this could have a really significant impact on future GDP numbers. And again, this is going to be more political cover for the Fed to print. Now, printing might blow up in their face. I mean, you can't print your way out of an economic crisis, especially one where you've got this confluence of factors, right? The countries around the world are not going to be looking to buy U.S. debt anymore. We're running out of foreign buyers. It was even recently that the Japanese finance minister said that selling U.S. treasuries, and the Japanese are the biggest holder of U.S. treasuries. They have more than $1 trillion of U.S. treasuries that they've accumulated. He said that selling those might be a negotiating card as they negotiate their trade deal. It might be a card on the table that they can pull. Now, he kind of walked that statement back a little later, a couple days after that, and I think that was because there's probably a lot of pressure on him from the U.S. to not make public statements like that undermines the U.S. debt market. But this is a real crisis that's brewing. Now, we've got $37 trillion almost in debt on the U.S. balance sheet right now. It's continuing to rise. You've got fewer foreign buyers. The pace of borrowing is increasing, and you've got interest rates in the U.S. remaining elevated. So, what is the logical conclusion to all of this? Well, it's that the Fed becomes the buyer and lender of last resort. And, that's the reason that Warren Buffett is so concerned about U.S. fiscal policy. It's not because the U.S. is spending a lot of money, but it's because what that ultimately means for the debt, it's going to be like Banana Republic style debt monetization, where the central bank is going to be the entity who ends up having to buy all this debt. It's not going to be the public. It's not going to be foreign holders. It's going to be the Federal Reserve. They're going to drive interest rates down, and this will be posed as a solution to the problem. You've already got Trump calling for lower interest rates. We don't even have this looming financial crisis yet. I mean, we are on the verge of a major crisis, but it hasn't hit yet. What's it going to look like when the crisis actually begins to play itself out, right? We already know that the last time there was a financial crisis, Trump was actually president. He was the first guy to jump on board and sign his name to stimulus checks. I mean, stimulus is going to be the name of the game. Lower rates, the Fed directly intervening in these markets. They're going to be dropping the helicopter money, but this time the problem is that it's going to be happening at a time when there's less goods flowing into the U.S. You can't reactivate U.S. manufacturing fast enough to make up for the deficit in goods, the goods that aren't flowing into the country. So you're going to have a deluge of fiat currency and a reduction in the supply of goods. It's going to mean massive price inflation or price increases. And yeah, it will be real inflation in the traditional sense of the word as well, because the balance sheet of the Fed is going to be expanding, and the amount of currency in circulation is going to be expanding as well. Now, moving on to gold here, let's just talk briefly about gold. Gold has had a little bit of a pullback from its highs of $3,500. It's gone on this rip over the past year. But if foreign countries are no longer buying U.S. debt, they're sitting on a bunch of dollars, what are they going to buy with those dollars when the trade war doesn't get resolved quickly? Well, they're going to buy gold. And that is the dynamic that has driven the price of gold up so rapidly over the course of the past year. Now, silver is a bit of a laggard here. It's true, it has come under some pressure as a result of the trade war and fears of a global economic slowdown. But to me, the thing is about silver, institutions don't really buy silver. They buy gold, right? The Chinese central bank, they've been buying up gold. Central banks around the world, they've been buying up gold at a rapid pace. However, if you look historically at the percentage of central bank reserves that are held in gold, they're still actually historically low. They're higher than they were because the central banks have been loading up on gold, but there's still a lot of fiat currency out there. I mean, it's just because there's so much fiat currency that the percentage of gold as a percentage of their total reserves remains quite low. So there's still a lot of fiat currency that could chase gold. And gold may continue to outperform silver for a bit here, but one thing that the elevated gold to silver ratio tells us, it's over 100 right now, that's pretty uncommon in history, is that the public really hasn't figured this out yet. But that could change very quickly, especially with a looming financial crisis. You might remember what happened back in March of 2023 when the banks started to fail, right? Physical bullion began to fly off the shelves, and the real price of actual silver skyrocketed. Premiums on things like 90% junk silver and US Silver Eagle coins skyrocketed. And that turned out to be a crisis that came under control pretty quickly, but it took a long time for the supply chains for physical precious metals to normalize. Right now, premiums remain low. That's another sign that the public just hasn't gotten the message yet regarding what is coming. Maybe they should be listening to Warren Buffett, but right now, retail investors are probably listening to Donald Trump. They're going out and they're buying stocks. They think they get a deal because the stock market has corrected slightly off of its highs, but I think they're going to be in for a rude awakening. A lot of these stock valuations may, in fact, be coming down in the future because of the impact that the trade war is going to have on their earnings. And yet, once that realization occurs, you're going to see a flight into hard assets among not just central banks, but the average retail investor. And when that happens, I think the price of silver is going to get bid up. Silver, again, central banks aren't buying this stuff. They're buying gold. That's why the dynamics have played out the way they are. Could the gold to silver ratio go a bit higher? Yeah, I suppose so. But right now, I am focusing on silver because it is so cheap relative to gold. And again, if you want the sure thing, yeah, gold, there's nothing wrong with getting gold here. I mean, gold is already at record all-time highs or close to it, but I think it's probably going to go much higher. If you want to know what I'm doing, I'll just share that with you. Currently, I already have a fair amount of gold and silver, especially silver. So I'm just kind of sitting tight and accumulating some fiat right now. I'm trying to keep some powder dry because with the amount of volatility here, it's not because, I think the dollar is some great store of value. It's not. Hopefully I won't be in, a cash position for a really long time. But again, I already have the physical metals that I think are necessary for just to, feel secure. I think there could be some opportunities to pick up assets. I mean, we might see a correction in gold and silver between now and the end of the year. Who knows? But any dips I would be looking at as opportunities to accumulate. You can go out and you can get gold if you want the sure thing. Look, none of this is financial advice, by the way. You can get silver if you're kind of more of a value oriented investor and you like buying things when they're really cheap. I think silver is an incredible deal right now. Silver tends to catch up at the end of these precious metals bull markets. If you want to get some fractional bullion, you can go with goldbacks. A lot of people don't like goldbacks because of the premiums. I think it's smart to have a few on hand because they are so divisible. Each goldback is 1/1000th of a troy ounce of gold. Another thing I like that you can do with goldbacks is they have free storage and 0% bid-ask spreads on goldbacks over at this place, the UPMA. You might have heard of them. And again, this is just what I am personally doing. You don't have to take part in this if you don't think it's wise. But they have free storage for goldbacks with a 0% bid-ask spread, meaning that they buy the goldbacks back for the same price that they sell them, and they'll store them for free. And you can put them in what's called a goldback lease, and you can earn interest. This is my single largest gold position, not precious metals position, because silver is still my predominant position. But as far as gold goes, goldbacks stored at UPMA in a goldback lease, they pay you goldbacks every single month, and you can't really beat that, earning interest on your gold. And a lot of people will kind of scoff at the goldbacks because they do have a fairly steep premium. It's about double the price of gold, right? So if you get 1,000 goldbacks, that's 1 ounce of gold. They are going to run you about, over $6,000. But if you got them at UPMA, they'll buy them back for that same $6,000 plus dollars, and you can earn interest on your gold. So I'm very happy with the position I have over there. It's my single largest position in gold. It's done very well as the price of gold has gone up. and it is paying me goldbacks every month. So, just to share with you what I'm doing. If I was going to stack physical right now, this is what I would be looking at: junk silver. As far as gold goes, if you want to get just, like low premium gold, guess if you've got a lot more money than I do, you can get something like a kilo bar. That's going to be your best deal. But these pre-1933 gold coins are also an incredible deal right now. SD Bullion has them $125 off per coin. This is, I think, like a 3% premium over spot for these pre-1933 gold slabbed and graded numismatic type coins. I mean, this is very low historically. This does show you that, central banks are what has been driving the bull market in gold. It's not retail consumers, because if SD Bullion is selling these for 3% over spot, that means that, they're probably having a hard time moving them. They probably are getting an influx of people selling these, maybe taking advantage of the rise in the price of gold, retail investors. Now, I don't think that represents the smart money. The smart money is the central banks that are loading up on this stuff. And, you can be in that camp too if you want to get some cheap, low premium gold that is trading at a huge discount to where it was previously. Even though the spot price of gold has risen, coins like this, they used to fetch a much higher premium over the spot price. So, this is something to take a look at as well. But thanks for watching, everybody. If you enjoyed this live stream, make sure you check out the video that's popping up on your screen right now. Leave me a comment down below to let me know what you think about all the topics that we covered today. Have a happy Friday. Have a great weekend. I will catch you next time. Smart Silver Stacker, out.